Well, today was a pretty crazy day. We got the official breakup between Elon Musk and Trump. Um, so Tesla kind of got destroyed today based on that. Seems like Trump's firing back and pulling out all of the government grants for Tesla. So
That's at least the
that's
fear, right? That's the fear that there's going to be some political backlash for subsidies, mostly around some of the other more privatized companies like SpaceX and whatnot. But nonetheless, markets continue on, right? So the stock market is going to function with or without either of those individuals. Either way, we saw some risk pretty much get beat up into the later half of the day or final hour when things started unwinding. 12 p.m. on, markets were pretty much just down with Tesla obviously leading the way lower there in terms of the big Mag 7 names, given the correlation to Elon Musk and the political beef that's going on. So
yeah.
don't want to get
Seems
too political, but yeah.
Yeah, it really seems like the Nasdaq has been struggling though. Even though it's grinding higher, the growth isn't really pushing through to get us into that risk on pivot just yet. And I don't know if the system is like sniffing something out with this growth that it's getting and keeping us out of the NASDAQ. Maybe there's an overdue pullback that's supposed to be happening here that the system is sniffing up on. But uh, the inflation index is pretty notable. Like we are seeing inflation expectations rise quite a bit. Not really seeing it in commodities just yet, though. So I don't think it's a cause for concern, but we might actually end up in an inflation regime pretty soon or stagflation if growth can't really pick itself up.
Yeah, I think like touching on your points there, the situation in growth, obviously we want to be long the Nasdaq. We're just right now the system has us out of it. But this would be the ideal position. It is the always the ideal position to just buy the Nasdaq and chill type of setup. But we're not seeing that right now. So I think that you're right. I think the system likely, not guaranteed, is sniffing out some sort of weakness in the future growth impulses where we're getting up there, but we're not quite there in terms of risk on dynamics just yet. We're still stuck in that slowdown land. And I think that as long as we're in slowdown, we have to, we've been saying this for weeks now in the podcasts. In a slowdown, NASDAQ and risk assets can go up, but they're more balanced in the sense that they can rise and they can fall with a much more equal distribution. So it's not so much that they can't go up; it's that it's very unlikely that they do, and that they do so with strong trends and stable rises, and therefore they don't make the best longs in slowdown. And the other reason that Nasdaq doesn't make a or risk full blown risk assets don't make a good long in a slowdown is the slowdown is the buffer between risk off and risk on. Think of it like the cushion. And when you fall out of slowdown to say back into risk off, you don't want to have exposure to sectors that made you okay in a slowdown, but then very, very poorly in risk off. Because what ends up happening is if you look back in the regimes, the difference between a slowdown and risk off is actually much more similar than slowdown and risk on. Therefore, you can trend and basically meander through slowdowns and risk off back and forth. And it's very dangerous to be caught long max risk there or max long risk there and then get, blindsided with an unnecessary drawdown. So that's why we tend to stay away from max risk exposure in those slowdown environments.
Yeah, and it's really important to note too that the Nasdaq has been rising. Like we have a position at the moment, not in the Nasdaq, and it's underperforming the Nasdaq since we entered our position. But in slowdowns, it opens the door to possible risk that comes in. So I think the Nasdaq can very quickly drop to Momo any day. Something can happen. It's prone to it. It's vulnerable when it's in a regime where growth isn't fully supporting current stock prices. So, yeah, at the moment we're underperforming the Nasdaq, but it can flip very quickly. And that's exactly the type of thing that we're trying to avoid since we're using triple leverage. You can't really be taking on those kind of risks without that full conviction.
Right. So touching on that there, the Nasdaq obviously, right, up in bullish trend. So there's very constructive price action going on here on the Nasdaq itself. Forget about this, separate the system for a second. So if you're just looking at the Nasdaq as a whole, the main driver here that you want to pay attention to is the trend and mid vamp. As long as you're in a bullish trend and above mid vamp, you have some sort of support here from price, right? In the Nasdaq. You don't have the regime supporting you, but if you're for whatever reason, say trying to be more tactical with your Nasdaq longs or your long Nasdaq, um, within the slowdown regime, a very simple approach would be don't let it lose mid vamp. Just keep if you're somehow long this and you want to ride this up and you think you're going to go higher, well, you should go higher without losing mid vamp. And if you lose mid vamp, then you get what we call bullish trend chop, which is not necessarily bearish, but it's just consolidative price action. And if you do get into that territory in a slowdown, the door does open quite quickly where that bullish trend chop turns into, something like this where you go through Momo and then you're actually into a new bear trend. So just be very careful if you have risk exposure. At least we would be if we were along right now.
Yeah, at least with triple leverage. Without leverage,
Yeah, of course.
it's
Yeah. Yeah.
not nearly that bad. But triple leverage, we need that full conviction. And the system also looks at that. It doesn't just look at, okay, here stocks are supposed to go up. It actually looks at, is growth strong enough to actually build a strong foundation and have a lasting risk on regime where it's worth going in with triple leverage instead of just a quick blip of risk on that might last just a few days and then fully reverse from there.
Yeah. And a good example would be just how um the Nasdaq is looking good. Bonds are not looking as good. Now, Nasdaq is in bullish trend, bonds are in bearish trend. So, in a slowdown regime, typically bonds are an available allocation if they're bullish trend. They're clearly not in bullish trend, so therefore we've been staying away from bonds for some time now, and we're not going to be touching them anytime soon, or at least until they're back into bullish trend territory. And given that their location within the bearish trend, they're not even at Momo. So you'd have to see a lot of hype come into bonds quickly. And we could see that tomorrow. We could see a positive move in bonds tomorrow with NFP, but I don't necessarily think it's going to be something where, bonds leg up from here to Momo and then rip even higher, right? Mainly because the situation in labor has been quite dynamic, but it's also interesting when you look at the fact that the unemployment rate's at 4.2%, and we've over the last say 6 to 8 months we've lost all this momentum we were picking up in Q1, Q2 of last year. This like real upward swing, it's been pretty much killed. So basically, we've equalized at 4.2% on the unemployment rate, meaning the significance of 4.2 today does not hold the same significance as 4.2 did in July of 2024. It's been somewhat neutralized. Everyone understands, okay, things aren't going to break at 4.2%. And I think that a good understanding of that concept is simply the SAM rule, right? The SAM rule is basically a simple rule that measures the momentum shift in unemployment. When it gets above zero point 0.5 percentage points, it is a signal that a recession is likely underway. Historically, it's been very, very accurate. Last summer was probably one of the first fake outs where it didn't work.
Yeah, that was the first time
Ultimately,
since 1950 that it didn't actually
yeah.
work.
Ultimately, you can see we've pulled off quite a bit from here. I do not want you to focus on like what does the 0.27 or zero point 0.5 represent. Don't focus on that. Just understand that this going up signals an acceleration in unemployment momentum, and this falling signals a deceleration in unemployment momentum. So ultimately put, unemployment momentum peaked last summer and has been fading since. So as you can see, even though the unemployment rate has stayed the same since last August at 4.2% essentially. The momentum has died off. What this means is for us to get that sort of shock where, oh my God, momentum is accelerating, we got a problem, and everyone to get spooked. For that SAM rule to trigger, unemployment has to print tomorrow at 4.8% to get back above that 0.5% barrier, which we know that is, I mean, if that happens, things are breaking most likely, right? Like
Yeah.
that's just an excessive jump. I mean, the street estimate tomorrow is 4.2. So I highly doubt we're going to see a 60 basis point, nearly, I would say impossible, right? Nearly impossible. Nothing's impossible, but that's considered nearly impossible. I think that the cushion there allows for a gradual, almost release valve in labor where it can gradually weaken and not necessarily spook the Fed or the market, given um, I firmly believe that if a recession is going to happen, the SAM rule will trigger. You're not going to get a recession without the SAM rule triggering. So if you can make that as your base case, that for a recession, SAM rule needs to trigger, which means unemployment needs to have some substantial momentum behind it. So if that's the case, if I believe that those fundamentals to remain true and to be the facts that when we get a recession, we are going to see that. So if that's the case, at least for me, that means that we have a lot of work here to do just to get momentum heated up again in the labor market. So you essentially almost have bought yourself some cushion here where labor can gradually weaken. Like for example, if unemployment comes in at 4.3%, it would be a new, call it cycle high, right, at 4.3%. But I don't necessarily believe that it would break anything, because at the end of the day, it's not a significant increase in momentum, and the Fed is already, their median or the medians for 26 and onwards are 4.3%, which are higher than where we are right now. So even the Fed is expecting some sort of continued labor market weakness. So again, a 4.3% print tomorrow when 4.2 is expected probably isn't going to do much to the bond market. On the other hand, I think that a 4.1% print probably is quite risk positive.
Yeah. Yeah, that would probably destroy bonds too.
Yeah.
Yeah, I think what we saw last time the SAM rule triggered and why it didn't work was we came from such a historically low spot. Like it was an extremely tight labor market. And so I think that move that we saw was a bit of a neutralization, kind of going back to a more neutral rate in the labor market. But that momentum from going to that neutral rate triggered the SAM rule. And it was a bit different from the other times where it wasn't really at a neutral rate. It was just rising because there was actual economic hardship coming in and people getting laid off. That move was just more of price action, regular unemployment price action. And so at this current level though, now that we're at 4.2, I think if we start seeing an acceleration in the SAM rule even before it triggers, it's going to be start getting priced into the bond market like once we're at like zero point 0.4 on the SAM rule.
Yeah, I agree with that. The TLT likely will be above. You get to point four on the SAM roll, TLT probably is back over Momo at that point.
Yeah. Yeah, so
But we're
that's
just
really what
not
we got
there
to
yet.
watch for. Like if next print is a 4.3, okay, like maybe this is the start. Who knows? But I don't think bonds are really going to react too much on a 4.3 print, but it could be a start to monitor for the next few prints.
Yeah, basically, all in all, there's some possible upside on softer prints here, or 4.2, maybe inline can get a little juice in equities, given that they kind of got smacked today into the end of the day, right? Like if we look at the Nasdaq, we faded into the end of the day here. Could this be the slowdown price action we were talking about earlier? Absolutely. It definitely has something to do with the headlines that were coming out at the end of the day. I think, especially with Tesla falling, given its Mag 7 weighting. Nonetheless, I think that, yeah, you have that slowdown risk, but you also have like a little bit of extra softness from headline risk into the end of the day here that could get offset tomorrow or neutralized with a moderate print. Maybe pushes some algos online and they start bidding. Nonetheless, I'm not very, call it junked up about this next labor market print, NFP print. I don't think it's going to really do much for us, quite
Do you
frankly.
think there's going to be some sort of effect from the tariffs embedded in there?
Quite honestly, I think it's a little too early to even start talking about tariff um, influence data because the tariffs have been mangled so many different ways. It's like we have a tariff on everything, but everything's exempt, type of thing where like the level of exemptions are pretty deep where I don't know if they're as significant in terms of um in terms of what the market originally thought they would be just back last in the spring, right? Or mid spring, early spring. Like when this was happening, the market was obviously expecting, from the poster card event, it was basically lights out and poster board. And since then, the market's repaired itself quite a bit, mainly I think on behind the fact that there's like a lot of these exemptions in place, which kind of offset most, if not all, the economic damage for the time being. But we're running out of time for those exemptions, right? And the exemptions themselves are not even as important as the fact that going into the Q1 of this year, we saw huge like beginning in February, we saw huge import surges in imports and inventory buildups ahead of some of these I saw some of these tariff release events, like these press releases where tariffs were announced, like inventory was already getting stocked up. And some companies even came out. I remember a couple of months ago reading, I think it was like 3M saying that they have enough inventory to last them into or through June, right? And this was months ago. So I'm assuming a lot of companies did do their part or some degree to hedge some of this tariff risk too, which would only offset or delay the impacts of the tariff effects. Because again, trade's a slow moving vehicle. You got from the time that the good's made until it shows up on the shelf, it's not overnight. So I think that there's a lag here that we can't really measure, especially given that the tariffs were not necessarily an overnight surprise to the market. They were, but I think like in terms of like the degree of them, that was pretty much the surprise. The idea that tariffs were coming, I think, was well known, and a lot of companies did try and were pretty proactive in trying to front run their inventory to prevent having to pay those higher import fees early on.
Yeah. So pretty much what you're saying, it's too early to tell, too early for anything to seep into the jobs numbers just yet.
I would have guessed that would be my take. Yeah, I think that I'd err on the side of some slight maybe early job cuts as weakness, right? Just tariff and just any type sort of like precautionary job cuts. But didn't we see the JOLTS number the JOLTS ratio bounce this week as well? So the number of job openings per unemployed person rose.
Yeah. Yeah, that's true.
So labor supply is actually expanding ever so slightly, which, not to say it's a one-to-one correlation there, but I think that that's probably a positive indicator, right? More than a negative indicator. The only hole that you could poke on that is I think the JOLTS data is a month behind, right? So I think that's April's JOLTS data from my recollection. Therefore, it's a little bit, stale in the sense of what we're looking at here, given the fast-moving nature of this headline environment. Thank you guys so much for listening. If you have any questions or want to see more about our models, go to our website at market-radar.com or find us on X at the Market Radar.